So Sean, what happens if energy prices do not stop their descent next year? You're in the renewables, the resource fund space, but since at least early 2014, you've been bearish on energy and on other commodities. Do you see more of the same?
Yeah, I would say there's more pain to go in oil, and that's why I probably have a different view than some of the people here about how 2016 is going to shake out for the market.
So,
In the
so
economy.
share with us, please.
Yeah, so I see oil going down to operating cash costs, which we think are $25 to $30 a barrel. We think the oversupply will persist. For 2015, it was roughly 2 million barrels a day. We think it's going to be roughly 1 million barrels a day when oil prices hit the $10 low in '86. OECD days of inventory were at about 70 days, and our models would suggest we're going to hit that in June or July. And so, and frankly, if we see that, there's enough worrying signs in the high yield market that suggest to me, energy and metals and mining represent over 20% of the high yield index. It was higher before these credits started taking a bath. That's not done. This setup, frankly, I'm not the house economist at T. Rowe Price, but this is just my view. This reminds me a little bit of 2001 to 2003. It was a 3-year credit downturn. It was around IPPs, tech and telecom. Telecom was 17% of the high yield index at the peak. Energy was 17% of the high yield index at the peak. I could see tightening credit conditions as a result of a credit event around commodities, and my guess is 2016 is going to be pretty disappointing as a result.
So Savita, if Sean's view plays out and crude oil sees 30, or dare we say a 2-handle, what does that do for not only earnings estimates in the S&P 500, but what does that do for the multiple that investors are willing to pay? Because conceivably, the headlines would be filled with carnage of North American focused producers, and certainly there might be some geopolitical ramifications as well.
Yeah, it's not a great scenario. I think that we would see a little bit more of the same of what we've seen over the last 6 years, which is that the market has basically assigned premia to 2 areas. One is sort of safe dividend yield or defensive bond-like stocks, and the other area are idiosyncratic companies like tech, like biotech, which have no cyclicality but just have really strong growth way out in the future. And I think we would see more of the same.
So we would pay up even further for companies that are divorced from the economic
cycle.
From
the cycle, exactly. We could see multiples go through the roof for those 2 areas of the market. And I think that, kind of comparing multiples today to historical multiples, I don't know if it really makes sense, because we are literally off the grid in terms of, kind of being at 0 interest rates and, the massive amounts of liquidity that have been pumped into the capital markets from central bankers across the globe. So multiples could surprise everyone in a variety of distortions, given how different this cycle has been.
So since...
Can I jump in?
Yeah, please.
I think that the other thing to ask is how long oil prices stay with a 2-handle or in the 30s.
So because is that an event that quickly is recovered?
Exactly,
or
it's quickly recovered because you do get a lot of production capacity shutting down, because at that point you have many producers who aren't covering their costs. So if it's a very short time, which is what we've seen historically, that oil spikes up and spikes down, then what you've got is a situation where you finally get the capacity reduction that everybody's been waiting for.
Involuntary.
But it's because companies that have been stretching and stretching to try to make it until oil rebounds can't make it any longer. And then you might actually see oil bounce back to where it is today.
So a definitive bottom could even be cathartic and
Exactly.
maybe be the flush that's necessary. Sean, do you share that view, or do you think it's a more prolonged downturn?
Yeah, so I think it's an interesting point. We can take analogs from the past. '86, we hit $10, and within 12 months we're back to 20. But it was a long bear. And I think if we're right and there's an event in the credit cycle, that's going to take a little while to wash out. I do think that there would be a bounce off 25. I think the new normal for oil is about where we are, $40. I think the real oil prices over 150 years are in the 30s. I think we're coming off a super cycle high. This is no different than the 1970s. Productivity and new technologies have changed the cost curve and collapsed it. So I think what will surprise people is, hey, look, if we're wrong about a credit event, people are going to be surprised by the fact that U.S. oil production is going to start growing again in the first half of the year anyway. And so I guess I'd wrap this up in saying, sure, we can get a bounce off that $25 or $30 low, but it'll be pretty short-lived because
So crude
capital will
oil,
come back in.
So Jim, I want to go to you on commodities just generally. So crude oil is down 63% from its peak. Since 2011, silver's down 70%. Gold is cut in half, just about. Copper's down 55%. Can you actually have global economic growth with raw materials having literally no floor? Are the two permanently at odds with each other, or is this something, people are going to say this time it's different, we're much less reliant on that stuff, and the reason is blank?
Well, it depends on who and where. So we've done a lot of work on the commodity cycle, and just some interesting numbers to frame what happened in the 90s and then into the millennium. So global capital spending for the big publicly traded miners went in 1991 from $4 billion a year to 2001, $14 billion a year. And that was really good growth in the 90s. China entered the WTO in 2001, and the game went on steroids. Global mining capex went from $14 billion a year to $125 billion a year in 2012. And so you went from an arithmetic growth function to a geometric growth function over the 20-year period. That is basically the story of EM and China over the past 15 years.
Right.
And it's not just China. We just did some work. 30% of global GDP is either China or the people that sell to China, i.e. the Australia, South America, Africa. And so it's a third of the globe is now basically downshifting, depending on your view of China's accounting, either dramatically or at least at a reasonable glide path. That's going to be a drag just on general global growth, because China's 1 point of global growth, and then the rest of EM selling into China is about 1 point of global growth. That's 2 points right there. That's a pretty strong headwind.
2 points of a 4-point pie.
Or 3 point, yeah.
these days.
And so I think we underestimate just the knock-on effects that China's 15-year, once-in-a-lifetime urbanization really meant for the rest of the world. It was an immense stimulus program, and it's now winding down. That's really important. And so I think it fits with your views. I think the views I'm hearing that we're going to get bifurcated. We're going to get bifurcated stories. We're going to get bifurcated valuations. There's going to be an awful lot of companies still facing real problems, and a lot of companies that are having secular growth.